Now, bear market is a market that has tremendous potential to offer you great opportunities for the next 2 3 years. And bear market, in my view, is the best kind of market because this is where you get hidden opportunities in stock market. The thing is, everybody panics when it comes to the market when it is moving lower. But the thing is, it is precisely this time when you get some amazing companies at discounted price. And this is where smart investors and traders see a bear market as an opportunity to make wealth over a period of 1 to 2 years. And this remains the theme of this particular week's video, where I'll break down the hidden opportunities in the stock market for you during a bear market and how you can take advantage of falling prices, negative sentiment, and at least prepare yourself for the next 2 to 3 years in order to create wealth for yourself. Now, the first slide I'll put up is that of bear market being the best market in stock market. And I'll just explain the chart here. What you see here is data of something like a Nifty 50. For Nifty 500 also it's going to be the same. For small mid cap index, it's also going to be the same. The data point that you see here, year 2000, 1500, this is actually the peak of 2000 bull market, and after that prices fell 35-40%. The 2008 number that you see, 6300, was the peak of Nifty back then, and then the price collapsed 45 to 50% in October 2008, that is. This particular data point that you see is peak of 2020 when price of Nifty was 12,300, then the price halved from there when we fell in March 2020. And this is the peak of 2025, actually September 24, when the price was 26,200, and now you see Nifty trading at something like 22,800 or whatever it is at. The point being that even if you invested in good companies, whether it is small caps, mid caps, large caps, at the peak of previous bull cycle, your portfolio value would still be up over the next 10-15 years. And this is where bear market offers you some of the best opportunities. I've taken the worst data point to make a point that broader market indices or the components of index like Nifty 50, Nifty Next 50, Nifty 100, Nifty 200, mid cap 50, mid cap 150, small cap 50, small cap 150, 250, these stocks generally over a period of time head higher. Of course, you can time it better if you know some basic chart reading skills, knowing when the market is bottoming out in 2000 or 2008 or 2020, or more recently 2025. We have already been in a 6-month kind of a downward phase. And the bottom, you cannot say whether the bottom is near or not, but a lot of stocks have corrected about 40-50%. So opportunities are definitely there in the market. In terms of classic technical analysis, the definition of a bear market is when price drops about 20% or more from recent highs. And I take this 20% not in a stock, but in a particular index. So if you see small cap, mid cap, micro cap, all these indices have fallen 20-23%. So definitely those pockets are in a bear market. Now, what are some common causes of bear market? Well, it is usually economic downturns. It can be geopolitical events. In our case, it is pure market correction. Market is falling purely based on its amazing performance from March 2020 to something like September 2024. The weight of that performance itself is enough for the market to correct. Now, the duration of a bear market on an average is about 9 to 18 months. 9 to 18 months is typically when market starts bottoming out. Currently, it's 6 months. We are going to have a lot of volatility in 2025. So I doubt the bottom is near. In some pockets, you can already see a bottom might be made. But again, the word is might because nobody truly knows how to time a particular bottom in the market. When price starts heading above 50 DMA, 200 DMA, that is usually about 10-15% above the bottom level. And that is when you should begin looking for the next amazing opportunities that may come in the market. There are some technical discussions around it that I'll cover as we progress in the video. Now, next section we'll cover is about the historical perspective. That is, bear markets don't last forever. Now, please watch the video either at 1.5x or 2x. There are a lot of beginners on this channel. That is why I speak relatively slowly so that everybody can understand. There are 3 subsections here. That is the type of bear markets. The first one is the global meltdown kind of bear market. This is the most severe kind of bear market that comes about. And this typically plays out every 10 to 15 years. That is once every 10 to 15 years. The examples are 1987, 2000, 2008, 2020. But this bear market actually offers the best opportunity for investors who have a 4 to 5 year kind of view on economy or a particular country. Currently, I don't think we are having this type of bear market. In this type of bear market, all asset classes suffer, which is not the case this time around. The second type of bear market is a 20% fall in index. Now, this type of bear market comes about every 2 to 4 years. And there are countless number of examples for this. 97, 98, 2001, 2002, 2006, even 2005 was some kind of a bear market in the market where index fell about 20 odd percent. 2011, 13, 15, 18, 21, and now we are seeing this in 2025. Now, this particular kind of bear market is limited either to the entire market or some sectors. If you look at the 2018 bear market, it was limited to the SMID space, that is small, mid, micro cap space, whereas the large cap space still held out well. This type of a bear market offers opportunity for the next 2 to 3 years, and it typically happens within a larger bull market cycle. See, I do understand that it is very difficult to imagine that we are currently in a bull market cycle where we are witnessing a 20% fall in index and some kind of a bear market, but it's mainly because a lot of people in stock markets have a recency bias. In recent times, post 2020, most of the people who have come in new and demat account, trading accounts have exploded post 2020. These people have never seen such kind of price action in a market where every morning you get up, index is down 2%, portfolio is down 4%. But for those of you who are in the stock market in 2005 or post 2010 or post 2015, this is normal for you. This is normal for you because these phases we have seen many, many, many times in the past 20 odd years in stock market. Because there is so much of recency bias, there are so many social media handles, there are so many YouTube channels, there are so many Telegram groups. This noise of the correction that we are going through is being amplified. And that is why you don't feel like you're in a larger bull market cycle within which you're experiencing a 20% fall in index, a 40 to 50% fall in the SMID space, especially companies where there were no sales, no revenue growth, no decent management, and a lot of debt. We'll come to that in a bit. The key takeaway here is that every bear market has been followed by a bull market, meaning downturns are temporary in nature. This is something you should never forget. So the next section we'll discuss is what kind of hidden opportunities are there within a bear market. The first is stocks on sale. So bear market typically allows you to buy strong, fundamentally sound companies at lower prices. Whenever you're experiencing a bear market, the first place to begin is to look for blue chip stocks with strong balance sheets and high cash reserves. I'll show you a template for this in the next section. The next category is growth stocks at a bargain price. A lot of high growth tech stocks, newly listed IPO stocks often get hit the hardest in the bear market. And this is true this time around as well. You look at the list of stocks that have listed post 2020, 2021, most of those stocks went up 3-4 times. And now look at what is happening. Look at the Nifty Capital Market Index. Look at the Nifty IPO Index. There's a vertical drop. Most of the newly listed names post 2023 have actually halved in price. There are a lot of fantastic companies that are listed post 2023. Just look at what is happening in that particular space. Stocks are down more than 30, 40, 45, 50%. So you need to look for those companies where there is strong revenue growth and solid business models. Again, some specifics we'll discuss. The third and the safest route is the index funds and ETF. This is actually a low risk way to build wealth. Now, Nifty, Nifty Bank, Nifty Small Cap, Mid Cap. Remember the first chart that I showed you here? This particular. So this can easily be done through an ETF. It is much more easy to do this through ETF as opposed to stocks, because sometimes even stocks within Nifty 50, Nifty Next 50, Small Cap 50, some stocks can go out of the index and some newer names can come in. That is why this particular strategy, that is of rupee cost averaging, you can do it through ETFs easily. I'll explain rupee cost averaging also in a bit. So in rupee cost averaging, you actually invest a fixed amount regularly instead of trying to time the bottom. It makes sense because nobody truly knows when the market is going to bottom out. Now, there is one aspect about insider buying and smart money movement. There are a lot of scanners nowadays where you can track what your famous investors are doing, marquee investors. You can go to mutual fund website and look at the best performing small cap, mid cap mutual funds, and you can see where they are investing their money. This is also the time to look into such data because in a way, this is a hidden opportunity. See, when there are 3,000 stocks listed in a stock market exchange, 3,000 or 4,000, it becomes very difficult to narrow down to the 50 or 75 stocks that you want to trade. You can do it certainly through some technical parameters, but if you combine some basic fundamental parameters such as revenue growth, operating profit margins, along with some technical patterns, then it gets relatively easy. And if you want to skip everything, then ETFs is the best way to participate. And it is a hidden opportunity because as market keeps moving lower, remember, ETFs also move lower because they are generally linked to the broader market index. But as we have seen in the first slide, whether it was the 2008 crash, 2000 crash, 2020 crash, over time markets will head higher. And that is where ETFs are a huge opportunity in such times. Now, the next section that we'll cover is how to take action and build wealth. The first step is having a strong watch list. Now, how do you do this? You got to stick to limited names. In this period, when the market is still continuing to fall every day, You have to stick to limited names. How do you identify those limited names? You need 5 to 10 high quality companies that you believe in for the long term. Remember today, when you're going to run a screener on your various websites or apps, most of the names that are dished out by that screener, you don't even know what those companies do, which sectors they belong, what is the scope of those sectors. That is why you need to believe in the long term with only those high quality companies whose businesses you understand. All right, don't select anything for the short term. It's absolutely critical in this phase. Now, how do you build a strong watch list? There are three key rules that Peter Lynch has taught. First, strong revenue growth. Second, low debt will always rule in the stock market. And third is profitability. So, what does he say about this? No matter what you hear or read, revenue growth matters. This is one aspect of stock picking that will never change. Now, what is said about the low debt rules? In difficult times or in amazing times, low debt companies will always perform well over the long term. Yes, in the short term, leverage might work. And this is mainly true for the small, mid, micro cap space. In the short term, these companies can do very well. But in the long term, if you have to hold 5, 10 high quality companies, you need companies with limited or low debt. Because that is what Peter Lynch has taught, that in the long term, low debt companies will always perform well. The third point is about profitability. If a business does not make profit, it won't make money for you over the long term. Stay away from companies that don't have a real business. See, this point, a lot of people are learning this in a very hard way. Post 2021, there were companies without revenue, without a business model, without sound management that were going up 2, 3, 4, 5 times. And people were blindly putting money in these companies. And today, most of these stocks are moving in circuits. You're not getting exit out of these stocks. So in stock market, there is a famous saying, you get what you want. If you're going behind companies that have no businesses, no revenue, no decent management, in return, over time, you're always going to get losses. This is one rule, again, that will never change in stock market. 50 years from now, 100 years from now, this is going to prevail. So in this section, we look at how does a good company look like. This is nothing but the results of a company over the last 10 years. You can start from the last 5 years itself, just to identify whether your company is real, whether it is into some business, it's generating sales, it's generating profit. So look at the sales trend. Look at the operating profit trend. Look at the net profit. Look at the EPS. Look at the PE. Why EPS and PE is important? Because ultimately stock price is a function of EPS and PE. So this is what a real business, a real company looks like. There are many companies in SMID space where the stock is at 2000, valuation in terms of PE is at 80, 90, 120, and you look at sales, it's 3 crores. So stay away from such businesses. It's not difficult to identify. A good company usually has such trends. Beautiful sales growth. Look at the operating profit margin. It's not that difficult to identify. So take a screenshot and whichever company you're interested in, look at the sales trend, operating profit, net profit, operating profit margin. This is basic template that Peter Lynch has taught. And this has worked in the last 20, 25, 30 years, even after he has stopped actively managing funds in the market. These are timeless lessons, again, that will never ever change. And you have to imbibe these rules within your day-to-day framework. Else you will suffer the pain of a bear market where prices drop vertically and you just don't understand what is happening. So identified the right kind of company in terms of sales, OPM, or whatever we have discussed. You then need to wait for the valid technical structure. Because without this structure, or without a clean breakout, or without a stock moving to a 52-week high or an all-time high, remember in bear markets, things can simply keep moving lower. Unless and of course you're doing some rupee cost averaging in an ETF. But in a stock, you cannot replicate that because you never know what is the bottom for a stock. So once you've found a company, you need to find stocks that are diverging from Nifty 500. So this is a chart where Nifty and Nifty 500 are heading lower. But look at this particular stock. It is setting up. It is setting up. So whenever the market bottoms out and the stocks has a clean breakout, that is when you begin allocating money. So it's a combination of good fundamentals, basic fundamentals, along with valid technical structure. While you do this for the future, that is planning for the future whenever the market bottoms out, you also need to do something with your current portfolio. See, a lot of people who don't respect basic rules like 50 DMA and 200 DMA would never lighten up positions when the market starts moving below these key averages. Whenever you discuss with a lot of market veterans, mainly fundamental analysts, about the importance of 50 or 200 DMA, most of them will laugh. Most of them will laugh because they view the market from a different kind of metrics. And technicals in general in stock markets don't get that kind of respect that fundamentals get. This is a fact, and you can't escape this. But 50 DMA and 200 DMA, 50 DMA for traders and 200 DMA for investors, is the greatest tool out there. And this is something I've repeated many, many times, that for trading, 50 DMA is your guiding light. And for investing, once the market starts moving below 200 DMA, brace yourself for disasters. And if it starts sustaining below it. So these are two key rules that you have to follow. We have a small community in this channel, and I am proud to say that using these rules, we were out well before the carnage started in the stock market. It's not because of some genius out here, it's because of the rules taught by legends like William O'Neill and Stan Weinstein, who always tell you to either balance your portfolio or get out of the market as you see markets sustaining below 50 DMA and sustaining below 200 DMA. And I can tell you, the way markets are moving lower, a lot of people have not even adjusted their portfolio or prepared for what may come in the market below a 50 or a 200 DMA. That is why at this point in time, you need to think whether you can rebalance or strengthen your portfolio. See, at this point, and again, I'm not an advisor, so it's not prudent to sell out your positions, but maybe for the next cycle, you take this as a key rule. As soon as the market starts sustaining below 200 DMA, you have to have an approach to sell weaker stocks from your portfolio that have decisively moved below 200 DMA, 200 DMA pivots also, and then allocate the funds to high quality stocks. So you can probably just sit out. Again, you'll have to do this for the next cycle in case some of you have not followed the advice of these legends of stock market. You can also use a rupee cost averaging strategy mainly in ETFs, not in stocks, because again, we never know where the bottom is for a stock. A rupee cost averaging strategy, which I'll discuss later, is where you invest small amounts regularly instead of trying to predict the market bottom. So let's say you put in 5% of your money when Nifty fell from 26,000 to 25,000. Again, 5% when it fell from 25 to 24. Another 5 when it fell from 24 to let's say 23. That is what rupee cost averaging is. The benefit is it reduces risk of buying early, and it actually smooths out volatility in the market, and it's relatively stress free. That is also something I can tell you. One more point that I'll highlight for current times is you need to stay emotionally strong, because bear markets are emotionally draining. Bear markets also tend to make people emotional, and it leads to a lot of bad decisions, revenge trading, revenge investing, and those kind of things. You need to stay away from it. What have legends of market done during these downturns and how they came out wealthier? This is what you need to study. If you've studied the books of Stan Weinstein and William O'Neill, you will know what you need to do in this phase. Don't panic. And then the most important in current times, turn off panic driven financial news. And in news, I will include all social media influencers. I will include analysts. I will include a lot of people who come on television and give you interviews every week, podcast every day, because that is not helping you. That is doing two things. Number one, making you more short term. That is the mindset. And number two, we are living in times of instant gratification where we want our PF to start performing from today, where we want market to start bottoming out today. So we are tuning our mind away from discipline and patience. So this is something that you again have to do. So this part, rebalance and strengthen, and the importance of 50 and 200 DMA, that is something you have to imbibe again in your daily routine for the next cycle. That is if some of you have not followed the rules of 50 and 200 DMA. I'm sure majority of you who are regular on this channel and many other channels who emphasize on this rule, I hope you have largely escaped from what has happened. Because go back and open the charts and see when Nifty started sustaining below 50 DMA and when it started sustaining below 200 DMA. 200 DMA pivots also. Even from there, you would have easily saved 20-25% of your overall account size. That is the importance of those rules. And if you're a trader, when do you again begin participating in the market? The rule is simple. Let Nifty 50, 500 move above something like 50 DMA and sustain. Market will give you tremendous amount of time to build positions. There's no rush, but let the market prove its mettle. That is what has been taught by these legends, and you have to follow this at all cost. Now, this particular section is about rupee cost averaging in stocks and ETFs. In stocks, I will still tell you this is a highly risky strategy because sometimes stocks just don't recover. So either do this in your long-term portfolio stocks, brilliant companies that you already know, already understand, or do this in broader market ETFs, Nifty 50, Nifty Bank, Nifty Total Market, those kind of ETFs. So this is just one template that I came across, which was a template that I liked, and that is what I'm going to share. But you can always modify it based on your risk appetite. So the thing is to build a pyramid. Maximum amount of money should come in when price has fallen the most. Those kind of things. So when the price corrects, something like a 5%. So whatever cash you have out of that 5% should go into the ETF. As it falls 10%, increase the allocation to 10%. As it falls 15%, increase the allocation to 20% of your cash, that is. If it falls 25%, then 35% of your cash you need to deploy. And if the broader market ETF falls 35%, as it has happened 3 4 times in the last 15 17 years, then you deploy about 45% of your cash that you have in that particular ETF. And then as it forms a new base and tries to move up, then you further add to your positions. So this is what rupee cost averaging is. Why is it risky in stocks? Because William O'Neill had a key rule that he taught, that the previous cycle winners do not become winners again in the next cycle. So this would mean that if you go behind some stocks that went up 5x or 10x in the previous cycle between 2020 and 2024, and you start doing this rupee cost averaging in these stocks, there is a higher probability that these stocks will never recover to the glory days they have seen earlier. And this is where rupee cost averaging will hurt you big time. That is why in ETFs, today Nifty is at 25,000. Let's say something terrible happens in the world and price corrects 35 40%. Is there a chance that in the next few years Nifty will again come back to the same level as it was, that is the all-time high? Yes, the odds are very high, because that is what has happened in 100 years of Dow Jones movement, in about 50 odd years of the data that is available in S&P 500, about 30 35 years of data that is available for Nasdaq, and of course about 35 years of data that is available for Nifty 50 also. So rupee cost averaging actually works very well in ETFs. And whenever the market corrects sharply, I think you should have some kind of strategy to deploy money in a systematic manner, especially when price is correcting. Because whenever the economic cycle turns, then there is a higher probability, as opposed to stocks, that ETFs, and I'm talking about broader market ETFs, let's say a broader market index like Nifty 500, S&P 500, or Nasdaq, or such kind of ETFs, not the micro sectors kind of ETF, because that is the sector ETF. That can also lag a lot. Even a mid cap ETF is a broader market ETF. Small cap ETF is also a broader market ETF. So generally these ETFs, whatever historical data suggests, they do come up and hit their all time high even after a vertical kind of crash that has happened, whether it was in 2000, 2008, or 2020. So RCA, that is rupee cost averaging, is highly beneficial in ETFs, and you should have long term SIPs to take advantage of this. Next slide that I put up is about mindset, because how you think actually changes everything. There are two kinds of broad mindsets you will see today on social media. One is the fixed mindset that thinks about bear market are bad, I've lost so much, everything is rigged in favor of big players, and no matter what I do, I always lose money. There is another kind of mindset, which is the growth mindset, which wants to learn what has worked in the past and how have legends used such phases to make money. And conditions, yes, are bad today, but what I will do is my homework and will wait for conditions to turn favorable again. See, this is something I cannot emphasize more about. Your mindset, your attitude, your way you look at things despite of being down and out today, despite of losing money, is what defines you as an investor or a trader. Between 2020 and 2024, when you bought stocks, everything went up. It was just so easy. And this is something I've discussed so many times, that when the market turns is when market shows who you actually are in terms of a character. How much pain you can tolerate despite of being rooted to your process of going through stocks, charts, basic fundamental data taught by Peter Lynch. This is what separates men from boys, if I can use the saying this way. Nothing is rosy in life, nothing will be easy, but the ones that eventually make it are the ones who, yes, know when to step aside, who know how to use limited money to test out market conditions, and then when the things turn favorable eventually, they know how to bet big. The template that I've given you is going to help you to a large extent, provided you remain positive, provided you can take this in your strides. Whoever you listen to, all the legendary traders, investors, at some point in time have lost 30 40 50% of their capital, and they're still bounce back, and they are where they are today. All right. So again, you can DM me your questions on Instagram. My ID is st_PYI. You can scan this code and directly follow me on Instagram. Keep your notifications on for further updates, because generally this platform won't recommend my videos because they are not eye catchy and clickbait, those kind of things. And if you do decide to share this video, do it with the right audience who aren't speculators and who are interested in learning about how to navigate through the phases of stock market. So thanks a lot for being here, guys. Have a great weekend ahead. Take care and be safe.